Hello everyone and welcome to this video. Have you ever heard financial pros saying that we use DCF? Well, when the job is on the line, they use something called relative valuation. And let's explore why is it so important. Well, first, it is easier to defend. The assumptions are baked into multiples. Next, it is easier to sell because you can say it's 15x better return while the industry comparable is just 10x. And it is easier to be wrong in the crowd. Well, if everyone is wrong, nobody is wrong, right? Now, let's go to the next part where we define the multiple. A multiple is nothing but a value metric divided by performance metric. Value metric something like price or EV, that is enterprise value. Enterprise value is defined as market capitalization plus debt minus the cash. It's like buying the whole company. Now, the denominator part consists of like earning, revenue, EPS or EBITDA. Now, if the numerator is, let's say, price, then we need to have something like EPS as the denominator. But if the numerator is EV, then we need to use something like EBITDA or revenue, that is the firm-based metrics in the calculation. Now, after define, we need to describe. To describe it, we need to see if the metric is skewed or is it like the median and the mean have huge differences or the outliers are affecting the mean. This will help us define that if, let's say, the P of a stock is 20, so we can analyze if it is overpriced, underpriced or adequately priced. Then, after description, we need to analyze it. Now, how do we analyze? Well, it's just like we can tell that there is a high PE. So high PE means high growth and low risk, or low EBITDA means low market capitalization. So the hidden assumptions must include growth, risk and the type of cash flow. Well, now the last part is to use everything that we have learned in the last three parts, that is apply. Now let's say the company's EBITDA is 500 million and the industry multiplier or average EV in the sector is 10x. So we multiply both and we get 5,000 million as our implied EBITDA. Now we subtract the debt from that and then we divide it by the number of shares, and what we get is our relative valuated stock price. We compare it to the actual stock price and we can see if the stock is undervalued, if the value is low, it is overvalued if the value is high, and if they are nearly same, that means the value is adequate. Now we need to understand that relative valuation is about pricing and not a foolproof valuation. It is fast, it is adequate, it is widely accepted, but it is not foolproof. Now, it is good to evaluate relative valuation for public firms. Now what about private firms? Now private firms have two major problems, that there is no stock price to compare after the calculation, and second is messy financials. Messy financial means the owner might not have included salaries or the Netflix bill is in the cash flow statement. So we need to adjust the cash flow statement and make some hard judgments to make it viable for the calculations. So when a private firm is going to sold to another private firm, we need to calculate the total beta instead of market beta. Also, because the owner might play a huge role, so the ownership risk must be deducted from the cash flow. We call it as a key component risk. Then also illiquidate discount for the asset, like illiquidable asset need to be discounted like 15 to 30%. Now the scenario 2, when a private firm is being to the public firm, in that scenario we do not use the total beta, okay, we use the market beta, and that helps it, and no discounting is required. So the last part is like when we file for IPOs, so we same use the market beta and no discounting, but we need to take care of a few factors, like how the IPO proceeds are being used, like for investment, for debt, or for what purpose. Then the amount of share that is given to the employees as stock options, and also there is an undervaluation by bankers because they want the IPO to be successful and they don't care about max valuation. The very last part is when a private firm is being sold or being represented to the venture capitalist or the VCs. Now, VCs care about their exit strategy and how much earning they can get out of it. So, they use industry comparables and they use high discounting for risk, execution, and everything. So, they're like that neighbor or that roommate who wants to move out before moving in. So, in the last, what I would like to recap is that in any type of valuation, whether you are using DCF or you are using multiples, we need to have a strong judgment as well as the storytelling ability. So, whenever next time you calculate the price, do look the story behind it and not just the number, and that is the key to the success. Thank you and see you in the next one.